right. Well, we're about to get started. Hello and welcome to this afternoon's webinar, AAII Shadow Stock Portfolio Annual Review, led by John Bajkowski. Thank you so much for joining us, and we're happy to have you all here. My name is Jenna Brashear, and I'll be your host for today. I'd just like to go over a few things before we begin. So I like to always remind our viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And we're having a little technical difficulty with the handout of the presentation right now, but usually you can find it under the handout section of your GoToWebinar control panel. I'll try to upload those momentarily. However, don't worry, because I will be able to send out a copy of those slides that we used in today's presentation to all those who attended. So if you registered, you'll receive them approximately like in the afternoon tomorrow. And if you have any questions for our speaker during the presentation, you can please submit them using the question section of your GoToWebinar control panel. And then once our presentation concludes, I will select a few questions for John to answer. And then maybe sporadically, I might interrupt and have a couple questions if they're applicable to the content that we're talking about. And then any questions that are not selected for the broadcast, we'll review them and we can address them afterwards. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar website for support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts and any resources that we discuss. And then the PDF is also, it will be available at aaii.com/webinars underneath the featured presentation. And for new viewers, we like to give a little background about our organization. The American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. So with that, I'd like to hand over the presentation to John.
Well, thank you very much, Jenna. Much appreciated. And thanks for the good job you do as far as keeping all the webinars going and getting all the information out to our members. You're a great contact for us, the local chapters, and the community especially. I enjoy the job you do there. So those questions you ask are always interesting, and I love to hear the members' response to those questions. So thank you so much.
Thanks, John. I do too.
So very good. Thank you. So with that, Jenna will try to upload the handout as we speak now. And if not, we'll make it available from our website through either email form or tomorrow when we go out with the replay as far as how that goes out. Our goal today, and my name is John Bajkowski. I'm president of the American Association of Individual Investors, and I've had the honor and the privilege of managing the model shadow stock portfolio since James Clunan has retired. Our goal today is probably it's a fourfold goal, I guess. We want to really present some of the theory that is behind why we created this particular model portfolio, how and the specific thought and care that went into trying to make the rules very practical on a day-to-day portfolio management standpoint. And it's too often you come across some interesting academic theories or concepts, but how do you actually apply them and how do they work becomes a challenge. And the model shadow stock portfolio is a real world portfolio that's been live now for 30 years. So over the time, we've made changes and made adjustments based upon real world experience with this particular portfolio. And so we're going to talk a little bit about the performance of the portfolio as well, the overall marketplace. It's been as any investor, I know it's been if you've been actively involved in either the stock market or the bond market, it's been a pretty tumultuous year last year, and it was almost a perfect storm where both stocks were down as well as bonds went down, and it was a difficult period to escape as far as having a good rate of return for your overall portfolio. But we're also going to then talk about the importance of having a long-term perspective, and throughout the presentation, I'll pepper in some resources you can use to either track the model portfolio or communicate with other members as well about the portfolio as far as how it goes. origin story of the portfolio. So this really goes back, and again, 30 years now. A January journal of back in 1993, and it was um, a simple matter of opinion from James Clunan titled "Thinly Traded Stocks: Putting a Practical Approach to the Test." And it laid out the ground rules of how one can go ahead and apply uh, and put together a portfolio using some interesting research that had come about. And let's get into some of that information right now. And what the research showed was that, and this goes back even before that period, but there's a small cap effect to the marketplace. And there's been a lot of evidence that indicates that smaller company stocks tend to provide longer, better rates of return over the long term, but they are perhaps a bit riskier. And let's get a little bit as far involved in the market cap element. So market cap, very simply put, is share price times the number of shares outstanding. And very often S&P 500 is discussed as sort of the proxy for the market. But in reality is the S&P 500, while it represents a large value in terms of overall wealth of the marketplace, represents only a very small percentage of companies. So 84% of the market cap is reflected by the S&P 500 in terms of companies, but they only reflect about 14% of the publicly traded companies that are out there. And as you start moving down the size range, getting involved in mid caps, small caps, and then micro caps, what you find is that the risk or standard deviation, the volatility of these stocks tend to go up year to year, but the possibility for longer rates of return starts to approach as you hold on to these portfolios over a period of time. And it starts to expose yourself to a whole new part of the marketplace that is often ignored by the institutions. And the term, shadow stocks, what does that come from? What does that mean? So the notion with shadow stocks was that when you start looking at these micro cap stocks that are thinly traded, that are largely ignored by the institutional marketplace, they kind of exist in the shadows of Wall Street. So you as an individual investor can go ahead and put meaningful positions into these interesting opportunities. You could do your research in that part of the market that isn't being actively researched. And again, given a sound methodology for making decisions on the buy side and sell side, you have the opportunity to go ahead and actually provide rates of return that are different than large cap stocks, and also long-term better for you as far as opportunity costs are concerned. So when we're talking about the shadow stock portfolio, we're talking about the smallest group of stocks. Most research, when they talked about small cap stocks, we're concentrating on the smallest 10% or 20% of stocks in the marketplace. And often when you talk about small cap mutual funds, if you want to invest in this group, they're actually probably participating more in that just segment above the small caps, because there's not enough liquidity for institutions to actually handle those really micro cap stocks. And I think as an investor, as an individual, if you want to take your time and effort to pick individual stocks, why not take your time and effort looking at that part of the marketplace that is a little less efficient and perhaps not as closely watched as other parts of the marketplace. Now, what you're going to find, however, is that the small cap stocks don't always necessarily perform in unison to large cap stocks. And there are periods of time where large caps perform better than small caps. And that is, part of the challenge of having a long-term perspective on the marketplace. In a typical year, it's 50-50. Is a small cap going to outperform large caps? It's almost a coin toss. That would be actually technically a coin toss. But as you start taking a longer perspective, 5 years, 10 years, the probability of having a small cap portfolio outperform a large cap portfolio starts to improve your odds. What they found, statistically speaking, is that in any given year, small caps may not do better than large caps, but long term they tend to perform better. And that's sort of an observation that we've had also with the shadow stock portfolio itself. In a typical month, the shadow stock's been now held up for 30 years. In a typical month, 53% of the time, the model shadow stock has outperformed the S&P 500. But with a 1 year advantage, it's again 55% small caps shadow stock versus the S&P 500. 3 years, it's funny how actually it's even closer, almost a coin toss, 50-50. As you start having a longer holding period, 5 years, 10 years, the likelihood of that small cap portfolio outperform the S&P 500 starts to grow. And so if you're going to be investing in this particular approach, it's a challenge to try to time it specifically when to jump in and out. And this is even true of large caps in general, or the stock market in general. If you want to have your money in a period of time less than 5 years, even 10 years, there's no guarantee that you're going to actually get more out of your rate of return than you put into it. If you want to take this approach, it takes a long-term perspective. So you really kind of want to set aside a segment of your portfolio to this particular area and then reap the rewards over time. You won't really necessarily have that happen for you shortly. So how does the market cap investing work? So what typically is done is to identify what's a large cap stock versus a small cap stock. The standard is to take a look at all the stocks that trade on the New York Stock Exchange and rank them from largest to smallest, and only take those stocks that are in the smallest decile for our study purposes, the smallest 10% of the stocks on the New York Stock Exchange, and then understand what that market cap range is. Is it 200 million? And apply that same market cap range across securities in all the exchanges, whether they trade on the NASDAQ or American Stock Exchange or New York Stock Exchange. So right now, and we typically do this with our particular portfolio. We've been doing it quarterly lately, but right now, the cutoff is for shadow stocks that lowest 10%, looking for stocks that have a market cap of below 300 million. When we first started this portfolio back in 1993, that cutoff was 55 million. It's been as high as 500 million. This goes back to the market right after the bounce back from the pandemic decline, and it was as high as 500 million. And last year we saw that decile shrink as the market was weak over the course of the year. That 10% segment started to grow smaller and smaller. So the other part, though, is that even though we're looking at microcap stocks, we want to make sure there's enough liquidity in those positions, in those stocks to take an adequate position. So we want to make sure the stock is at least 30 million in size. Originally it was 10 million, and we avoid OTC stocks, pink sheet stocks that aren't traded actively, that aren't filing statements with SEC on a regular basis. So really, the other parts that come into play as far as considerations is that we are excluding financials, and that is a challenge a little bit because we are excluding a big part of the marketplace. But all the studies that looked at this market segment, they basically excluded financials because when it comes to book value, financials have unique assets and liabilities on their balance sheet, which makes them very non-comparable to other kinds of firms. So the price to book ratio is very useful, but it doesn't work very well on financials, and that is a limitation. So we automatically exclude those kinds of securities from consideration for the model shadow stock portfolio. And why does it work? I mean, it's basically, is it the perfect ratio? No, but it does give you a good sense for what the overall assessment of the company, of the value of the company relative to price, to the overall book value of the company, that which is represented by that owner's equity or book value. So the lower the price relative to book value, the greater likelihood that perhaps there's some sort of mispricing going on, things like that. So we're looking at stocks that are small, and then we're also looking at stocks that are cheap. And that's sort of the intersection when it comes to the shadow stock portfolio. When it comes to the actual study that led to the creation of the model shadow stock portfolio, this was sort of the interesting observation that was made, that generally speaking, the smaller a stock, the greater its observed rate of return over time. And also the cheaper the stock, measured by price to book value, the more attractive its valuation. So in this case, and the more attractive its rate of return. When it comes to the shadow stock portfolio, what we're looking for is that smallest intersection, that yellow line in the corner, which is the smallest stocks and the cheapest stocks measured price to book. And the other thing to consider when it comes to creating this portfolio or any kind of implementation of these types of approaches is that we're not doing a lot of in-depth company analysis. We're not doing top-down analysis. We're looking at how the overall economy is going to be doing. So it's helpful to build as large a portfolio as possible to capture that. Because what you're going to find, and I found this personally, when you put together these portfolios, you're going to have probably a couple of companies that are really outstanding buys, attractive, that generate a lot of the performance from the portfolio. You're going to have the majority of stocks are going to just simply follow what the overall market does, and you're going to have some losers as well. So it's important to have rules in place that tries to capture stocks that are going to allow them to rise over a period of time, and also rules in place that sells off those stocks that are underperforming the marketplace. So the study that was based upon all this was the Fama French study, and that was the basis of the creation of the model shadow stock rules. And price to book was chosen at the time. It was considered to be a better measure, better predictor of future performance versus the price earnings ratio. And the other part that was attractive to it is that it was really based upon company fundamentals, but it was dealing with this part of the marketplace that was so small that it really was handpicked for the individual investor as an area to participate in and try to gain some market advantage. So overall, price to value, price to book works because it captures really kind of what the overall consensus of the marketplace is. And market cap works because typically these are riskier stocks potentially. And the two combinations, I mean, when it comes to long-term performance, why does it work? I mean, I think there's a couple of questions you probably want to ask yourself. Why would this approach work? It's going to work typically because A, it takes on greater risk. So just generally speaking, there's more volatility in investing in small cap stocks. There's greater risk in investing in value stocks. And that's where some of that return comes from. The other part of the equation is that of behavioral biases that might exist. And typically speaking, again, small cap stocks, these micro cap stocks are somewhat neglected. Often they're fallen angels, stocks that are beaten down, but have the opportunity to come back. And people tend to be overly pessimistic when it comes to stocks that have fallen down. And they typically undervalue their future true worth. So there's a behavioral bias there. And they're neglected. They're fallen angels. So you have the element of a little bit extra risk in terms of volatility and a behavioral bias as well that helps to give us the opportunity for this approach to work long-term. And it has worked across different kinds of market environments. It has worked across different countries, and it has been persistent over time. So that is a thing you always want to ask yourself is why does this approach work? And will it tend to work in the future? When it comes to the actual portfolio itself then, so when we're talking about our primary value criteria for the shadow stock portfolio, we're looking at stocks that are in the lowest 10% of the overall consideration for the portfolio. So this number changes over time, just as the market cap changes over time. When we first started the portfolio, it was 0.61. So we're looking for stocks that had a price to book ratio of 6.61 or lower. It's been as high as 1.1 back in, again, this is our recent high valuation period of 2021. And last year it's been sliding down a little bit. Now our current cutoff is 0.90. So when we're talking about adding stocks to the model shadow stock portfolio, want them to be micro cap with a market cap of 300 million or less, and they want them to be attractively priced with a price to book value of 0.90 or lower. Now your handout has the particular ratios over time that we've used, and the model shadow stock portfolio is not static in a sense that the rules have changed over time as we've understood what works well. The biggest challenge we found with managing this particular portfolio is that because they are small caps, they're not necessarily traded that liquidly. You have to kind of, you can't trade them. Very often there's a high cost or a cost to buy into them. There's a bid-ask spread. And if you go ahead and try to sell them quickly, or a lot of people try to sell them quickly, the price tends to go down as well. So you're better off trying to hold these for a longer period of time and trade as little as possible. And Jim Clunan's philosophy was that really, for the most part, we don't want price to drive the decision. We want economic activities such as earnings reports, changes to price to book, to actually drive the portfolio. It was meant to be a situation where you don't have to necessarily manage it that carefully. Now you can manage it more closely if you want to, but the notion was to buy a relatively large diversified set of stocks and then review them slowly over time. And as new research comes out, we'll perhaps change them. For a while, we're also adding in price to sales ratio as a criteria to go ahead and make decisions for the buy side of the portfolio. We found that it didn't add that much value, therefore it was eliminated back last year. So as new research comes out that makes it worthwhile to switch things, we'll consider switching them for the portfolio. And it's a living, active thing. As we learn from how to buy and sell things, over time, the transaction costs have come down. So we try to make adjustments to that and give you those rules and some guidance to how to go ahead and do that. One of the other things to consider that, when it comes to risk is that what they found with a lot of value securities and the microcap stocks was that there's a lot of junk down there, a lot of really, really crappy companies that probably don't want to actually are perhaps past the level of bouncing back. So it's important to have a little bit of quality in there. And the better returns from the small cap value comes from ignoring the worst of those in terms of financially and focusing on at least some of those that have some reasonable financials. So one of the criteria we look for beyond being that small value is positive earnings. And we want to look at again, it's a very simple test. It's not a great encompassing financial test, but we want companies to be currently profitable. And we sell them when they stop being profitable. Now, we give them a little bit of time to understand or to write that out. We want to, if a company just happens to have a one-time earnings downfall, we wait for at least one more quarter to see whether or not the company was able to turn things around. But then over time, we found there were a lot of companies that were coming in and out of the portfolio. So we also went ahead and started to avoid stocks that were really in the portfolio in the most recent 2-year period. Ones that are kind of on the margin of being profitable, not profitable, they were still potentially being priced well. But it's important to have some level of financial strength as a secondary factor for going ahead and considering things. Other things we found as far as important when it came to considerations of quality is that over the years, we come across some of these less liquid stocks in the shadows of Wall Street, and it was best to avoid, in some cases, Chinese listed stocks. We found that the financials weren't necessarily as frequently filed. It wasn't as easy to actually judge whether or not everything was accurate. So as a rule of thumb, we simply avoid stocks that are listed from Russia or China, which is sort of interesting, kind of, I guess, helped us out last year. If there have been any Russian stocks. It's always a challenge investing in any kind of country that's emerging, which is not really where, in effect, the government at any point in time go ahead and take over your assets. We also avoid, as we said before, financial stocks, leasing stocks, rental companies, REITs. And those are just, again, because their financials aren't comparable, and the ratio we use, price to book, is not really an important ratio to consider in that regard. And then we avoid companies that have not been up to date with their filings. And even though these are exchange listed, companies sometimes fall behind in their filings, and they may get a short-term variance from the exchange to stay listed, but you're better off making sure that the information you're getting is current. Not all of these stocks are followed by analysts. They may not have earnings estimates or earnings revisions. And as such, you want to at least have current and frequently correctly filed financial statements to go ahead and judge what's happening with those firms. When it comes to actually constructing the portfolio, the guidelines we've kind of came up with originally was that, again, this is not, and it depends on how much time and effort you want to put into it as well. We follow just a pure quantitative approach to building this portfolio. And we don't take a lot of time and effort analyzing individual stocks. We don't make any sector bets, industry bets. We simply buy whatever cross-section of stocks that pass, and we sell them when they are no longer cheap, no longer small, or when they have negative earnings, or when they're bought out. So the less time and effort that you put into picking your individual securities, the more important it is to have as big a basket of stocks as possible. So it's very important in that context. And nowadays it's become relatively cheap. You don't have to worry about brokerage costs. Bid-ask spreads aren't that bad. You can actually go ahead and buy, if you want to follow the model portfolio as a whole, you could buy all 30 stocks. You don't have to, but I guess for me, I prefer just to go ahead and buy the whole basket, with the understanding is that I want as great a chance as possible to get a few of those really big winners that are likely to come out of this. Again, I'll have some losers as well, but it's most of the returns you'll find I found in my personal investing, whether it's through this model shadow stock approach, whatever approach you come from, is often your returns come from a few holdings that do very well that you allow to go ahead and rise and give you some rates of return from that. So again, when you are investing, try to do equal dollar amounts, and if you are going to build your portfolio over time, figure out how much you're going to be holding there. And so I guess there's some questions coming in there, Jenna.
Yeah, we've got some great ones. I'm not going to overload too many right now, but just because we talked about some of the criteria that you do, consider when putting the portfolio together or selecting which stocks can be that can qualify. So one of the questions, let's see, from Bill, he asked, has anyone ever looked at adding a momentum criterion to the portfolio?
It's a great question. So what we did and what we've experimented with over time is using momentum as a tiebreaker. So let's say that you want to add, you have enough money to add 5 stocks to your portfolio, and you can go to the ideas section of our website, and you can get a list of, say, 30 stocks pass. How do you go ahead and pick which of those 30 to consider for your portfolio? So what we've experimented with over time is, how do we use momentum as a tiebreaker for stocks that have the same financial qualities that are desirable? So we'll either use a short-term measure such as 26 weeks or 52 weeks, or we'll use the weighted relative strength momentum rule that is being used in the VMQ portfolio. So it is used as a tiebreaker to pick and choose. If I have more than one opportunity to look at, how do I pick stock A versus stock B? You could look at industry diversification, you could use momentum, look at the lowest price to book, but momentum is one of the considerations to use in that regard.
And then one of the other questions, I'll probably leave a couple for later, but one of the questions I thought was a little bit similar or on topic was, why was the price to sales ratio dropped?
The price to sales ratio was dropped because it wasn't really it didn't add much value to the actual final decision point. It was almost all the information that was in the price to sales ratio was being captured by the price to book value. And so it wasn't really net additive to making a decision, as far as it wasn't differentiating enough stock A versus stock B. And if anything, what we found, what it was doing, the stock ratio, price to sales is an interesting ratio in that it's almost, I find price to sales as a ratio that's best compared against industry norms, because the price to sales ratio is very dependent upon the profit margins in which a company typically operates. And our price to sales ratio was looking for just an absolute filter. And the challenge then is we're just simply automatically excluding certain industries. So it's normal for a stock with a very low price profit margin, say a grocery retailer, trade with a low price to sales ratio. But a company that is a high profit margin company, let's say a technology company, a software company, will typically trade with a higher price to sales ratio. So you're better off when it comes to price to sales, comparing a price to sales against the industry versus just a raw number.
And one last question, what determines when you raise or lower the maximum price to book ratio?
So what we do, it's a process. We look at all the stocks that are in the New York Stock Exchange, and there are filters that are in place. We exclude ADRs, we exclude foreign listed companies, and we rank them in the case of price to book from highest to lowest. And we look at those that make up the lowest decile, lowest 10%. And that number, as the overall market valuation changes, that number goes up and down. So our goal is always to look at the stocks in the lowest 10% of market capitalization or price to book. So as the overall market becomes more expensive or more cheap, those numbers change. If we kept that number constant over time, what you'd find is that basically when the market was very expensive, very few companies would pass, not because you're dealing with probably less than 10%, whereas when the market is very cheap, you're going to have more than 10% of the companies passing using those fixed numbers. We're trying to basically simulate us getting to that 10% level. We do it annually. We're doing it quarterly. Perhaps that's too much, finding the right balance of how often they change that number. But it depends largely on how the market is reacting. The more the market moves up or down, the more there's a need to adjust that number.
Thanks, John. Yeah, I'll let you get back to your presentation. Thank you so much.
Well, thank you. And one of the best resources to get information on the shadow stock portfolio is on our website. We also publish a quarterly article in the AAII journal, but on our website, under the section called model, actually, I think we go to our website, I think it's called model portfolios. And in there, you actually have access to all the collective information that is tied to the model shadow stock portfolio. The homepage gives a rundown on the most recent transactions that occurred, buy or sells, the performance, as well as any kind of articles we published about the article, about the particular portfolio, either in the journal or as a monthly commentary. So as a member, go ahead and sign up for the shadow stock monthly newsletter. It'll update you and keep up to date of any kind of changes to the portfolio, any changes to those market cap levels or price to book levels, or any kind of observations you might have about the news in the companies that are in there. And so if you want to look at the actual portfolio, if you go to the model shadow stock area, under model shadow stocks, one of the first links there is the actual portfolio itself. It lists the current holdings. It indicates any kind of special footnotes that might occur, whether a stock is currently qualifying, whether it meets those initial buy criteria. We'll be talking about selling in a moment, whether it meets those initial buy criteria, whether or not it's on earnings probation, or any kind of interesting elements to it, whether it's getting perhaps to be too large or too expensive. So if you go to our and this is updated every day, so we go under information and it's kept live, so you can always get a sense for what it is. And you could also use our portfolio tracker to go ahead and track these yourself. So you want to put together a watch list. If you want to become comfortable with the concept, you can go ahead and click on the little yellow circle next to a company sticker, build your own watch list on our portfolio tracker, and watch those stocks over time, become comfortable with the concept. And one of the things you could also do is when you are looking at the current shadow stock portfolio, there are options to download an Excel or a print file. This happens to be, I this morning before the presentation, I went ahead and clicked on that Excel download link, and I downloaded the current portfolio. I went ahead and I sorted this particular portfolio, and this is how we talked about relative strength. I happen to sort this particular portfolio based upon the price to book value ratio. These are all 30 stocks that are currently in the portfolio and are rated from lowest price to book to highest price to book. And on their notes, you can see actually the lowest two currently are showing NMFs in the price earnings ratio column. And what that means is that their GAAP earnings are negative on a trailing 12-month basis. However, their adjusted earnings, and these are the earnings that are trying to take out the impact of extraordinary impacts on the earnings, are actually positive. Now, again, it's always risky. There are some people that say that when it comes to operating earnings, that's earnings that ignore all the bad stuff. So you don't want to be necessarily just looking at the overall ignoring anything necessarily negative. But we found that it actually was helpful to look at operating earnings, or actually earnings that ignore these one-time special situations. And so if you are building a portfolio, I mean, from scratch, I mean, you might focus in on those stocks that are currently qualifying as a starting point for putting together a portfolio. Or you might look at the stocks that have the best relative strength. In this case, Sigmatron International has one of the weakest relative strengths in this portfolio. It is one of the smallest. But if you want to look for a stock that it actually is doing quite well, and actually it's tightening machinery, but it's actually close to exceeded its size limit right now. It would actually be a sell based upon its size. Now, another thing to consider is that oftentimes when it comes to selling a stock, and we'll talk about sells greater in a moment. I mean, if you are managing a mid-cap portfolio and a stock is still attractively priced, I mean, there's nothing wrong with keeping some of these holdings. Often we hate to let some of our winners go when they're still priced attractively, only because of size. But you can go ahead as an investor. You can choose to keep that in your own mid-cap portfolio as long as you watch the valuation level. So the current portfolio is always available for you to view. And if you want to get some fresh ideas, we also have an ideas list. The ideas list is a list of all those stocks that pass all the initial current criteria, have a market cap between 30 million and 300 million, have a price to book ratio that is below 0.90, have positive earnings, are exchange listed, are up to date on their financials, that are domestically headquartered. So every day we update this list. We also note if any of those passing stocks are currently held in our actual model portfolio. But if you're looking to get some fresh ideas, build a portfolio on your own, this is a great opportunity for you to go ahead and get some fresh ideas that are in the microcap arena that follow the spirit of the portfolio, and give you an opportunity to go ahead and get some good ideas. Now, when it comes to the portfolio itself, one of the key things when it comes to investors is that ideas are often easy, and we're bombarded with ideas. The challenge often is one of selling and knowing when to sell. And it's just as important when you put together a portfolio, whether it's a quantitative portfolio like the model shadow stock portfolio, whatever approach you want to follow. When you come up with why you're going to buy a stock, you also want to come up with what's going to make you sell that stock. It's very important to have those rules in place. And with the model shadow stock portfolio, we wanted to let some of these cheap stocks run up a little bit in price before we sold them, and wanted some of these small cap stocks to get a little bit bigger in value. On the positive stuff, we want them to grow a little bit. We don't want to sell them right away. We want to sell them when they're more expensive. So we sell them when they're 3 times the initial criteria when it comes to buy a stock. We'll sell them for negative reasons if earnings become negative. So I'm not going to get too detailed or too hung up in some of these particular rules, but it's so important to really have rules in place, and it's critical because when the market is going gangbusters, it's easy to buy stocks. You can fall in love with your stocks. When the market is struggling, you perhaps want to ignore your portfolio. But with the rules in place, you have some standards by which to go ahead and make decisions. It's too easy just to let our emotions drive us. And so it's important to have both really a disciplined approach to buying, a disciplined approach to selling. And I think that whether you're a growth investor, value investor, momentum investor, the successful investors long-term have a disciplined approach that is sound and they follow. And with the shadow stock portfolio, the approach is to try to buy the cheapest and the smallest companies, let them become a little bit bigger, more expensive before we sell them. Or if they become negative, or if they've been held onto our portfolio for too long, 4 years or so, they haven't gone up in price, they don't qualify anymore, we go ahead and look for other opportunities. So it's really important to go ahead and prune your portfolio over time, but also let those winners ride a little bit. Too often, the human tendency is to go ahead and sell off your winners too quickly, hold on to your losses too long. That's sort of the tendency for us as emotional beings, and having a good set of rules in place to help guard against those emotions is critical to long-term success. And these are some additional, if there's not enough money, so the number of portfolio holdings changes over time slightly, depending upon whether or not we're selling off some big winners or selling off some losers. But typically, you want to, when you are investing in new stocks, you want to roughly buy what the average portfolio size is. If you have money left over, you could always reinvest that money into smaller positions that still qualify. And you could also change the price to book value. You want to find some more attractive values. Now again, we do this once a quarter. And unless, of course, a situation like a buyout occurs. But the notion is that you don't have to follow it more closely. You could always, if you want to be more active, you can be. But the notion here was to try to follow what they do in these academic studies and focus in on company events, earnings announcements that actually drive changes, fundamental changes to a company's prospects, and make that the driving decision. So you could always, again, follow more carefully if you want to. Perhaps you could add some value by that way, but you don't have to. And for us, we do it quarterly. Again, you can't ignore a portfolio. The rules change, but I think you also don't want to understand this is not a trading portfolio. This is a long-term investment, and it's actually costly to trade microcap stocks. And you can always find the rules online. If you have any questions as far as how to follow the rules, they're available on our online thing. If you want to get a sense for our transactions, we list all of our transactions in a summary form like this, where we actually indicate per quarterly what our changes were, why they were sold, what we bought. And there's also a detailed listing if you want to get all the dividend information, how many shares were bought and sold. We actually provide that information as well. Very transparent. And I guess the question often comes up, well, what is the portfolio turnover? How active is this? So this information goes back, this study here goes back to 2004. And over that time period, on average, our holding period is about 4 years. About a quarter of our portfolio gets turned over the course of the year. That's been at about 10 buys/sells per year. We've held about 30 stocks on average. And from inception, the portfolio rate of return has been 13.5%. And let's talk a little bit about our current, most recent performance. And 2022, almost a year you hate to say, was actually a tough year for both stock and bond investors. And our portfolio did suffer a bit. It was down 19.7% last year. And we were beating the market till December. And what we found with the model shadow stock portfolio, and this is probably true of microcaps in general and small cap stocks, is they tend to be more volatile in the market. When the market goes down, they're less liquid. They tend to fall quicker. They tend to bounce back quicker. The market's been very kind to the portfolio so far this year. So you have to expect a little bit extra volatility. So last year was a tough year for the model shadow stock portfolio. It was down 19.7%. We had some pretty strong winners and some pretty big losers as well. And your handout has this list of all the stocks that were held over the course of the year. So some of the logistic companies actually did quite well, or our best performers, either ground-based or marine-based. They were the best performing stocks in the portfolio last year. And our weakest holdings were the consumer cyclicals, apparel company, retail store, Mesa Air Group, a regional airline that ran into trouble because basically it couldn't get pilots to actually fly its planes, and hurt the stock as far as its ability to actually service customers, because all the pilots ended up going to the majors. So the important thing here again is to try to hold as many stocks as you can, because you're going to have a couple of these big winners that are going to really boost your performance, and majority of stocks will be probably follow somewhere in the market area, and hopefully you'll be selling off your losers before they become too big of losers. Last year was kind of interesting year for the stocks in general. What we found in 2022 is that after many years, almost 7 years scenario, where typically speaking growth, large cap growth did better than value stocks, 2022 was a year where value as a whole typically did better than growth, and that was kind of a interesting transition. And hopefully that'll be a pattern to come, because what you're going to find very often with microcap stocks is they typically have runs. They have runs in which they tend to outperform large cap stocks, and then they have runs where they typically underperform small cap stocks. So it's the question now is small cap value, is it now due for its next run? And if you invest in these things, again, it's difficult to chase last year's return, but understand that there is a pattern of situations where typically these small cap stocks have what's called serial correlation, where last year is somewhat predictable what will happen the next year. So hopefully we're into a period where small cap value will tend to outperform large cap value. And we touched on this chart before, so I'm not going to get involved in it too much, but I do want to talk about the current downturn. And I mentioned that small cap stocks, normally speaking, are more volatile. They fall to the downside and more quickly than large cap stocks typically do, but they typically bounce back more quickly. Now, it hasn't been the case most recently, and the last 7 years have been sort of tough. And this current downturn, actually for large cap stocks, the downturn began in January, beginning of last year. The drawdown was as much as 24% from beginning of January, and it's lasted all of last year. What we found with small cap stocks and the broader market as a whole, the broader market was actually struggling a little bit even before the beginning of last year, and the bear market for the shadow stock portfolio has actually been going on for a year and a half now, and this drawdown was actually bigger, 36.5 versus 24% for the S&P 500. So the lesson here, I guess, is that it takes some patience, but let me actually highlight that when it comes to timeframes and losses, if you're going to have just a 1 year holding period, I mean, there's a higher percentage, a higher chance that you're going to have a loss in that particular rate of return. The longer you have your holding period, the longer your perspective is. In the case of the stocks as a whole, you almost have to think of having a 10-year holding period, a 15-year holding period before you could actually have a high level of assurance that you're going to have a positive rate of return. And that's just part of the nature of investing in stocks. When it comes to your ability to get that higher level of return, you're sort of trading the likelihood of short-term volatility for the possibility of greater long-term rate of return. Now, you may be tempted to say, well, why not just simply, who wants to have a big drawdown like this? Perhaps I should go ahead and actually try to trade in and out of the market. It's very difficult to do. And one of the challenges with trading in and out of the market is that very often your biggest returns up are right near the biggest down periods. And this is a table, and all these tables are in the handout, that it shows what's the impact if I just skip. Now, if I'm prescient and I'm able to go ahead and avoid being in the worst months of the market, I could certainly raise my potential rate of return. But then what if I then skip the best return as well? And what happens is sort of interesting. If you look long term, if you skip both the best and the worst month of the year, your rate of return is actually lower than just being invested in the market the whole time. And if you skip just the best month and every year, long term, you drop your cumulative rate of return from a 13.5% to 2.7. And in the case of the S&P 500, you go from a 9.6% annual rate of return to a 2.8. Visually, what you see then is that just skipping that 1 month return really reduces your long-term capital appreciation. Now, there are, looking at more recent academic studies, there are some market trending approaches that have good long-term success. What they typically do, and this kind of coincides with being out of the market during the best and worst months, most of the more successful trend following approaches, they don't necessarily improve your overall rate of return. They are typically better at reducing the volatility. And interesting area to study, but it's very difficult to time the market perfectly, and just missing the one best month of the year actually reduces your rate of return long term pretty negatively.
I just had a quick question. I thought it was a little bit of applicable when you're talking. So Ron had a question. When you say a 10-year holding period, does that mean that that you have to hold it for 10 years, or what does that mean in regards to someone who's following the portfolio?
Yeah, when we're talking about these statistics, we're calculating rolling 10-year returns. So it is, in this case, the calculation was made assuming you bought it and held it for a 10-year period, and then next month you buy it and held it for the next 10-month period, versus a 5-year period versus a 1-month period. So these assumptions are based upon those measured holding periods. And that's just, I guess, the important lesson in general when it comes to investing in stocks. And if you're going to need that money in 5 years, Jenna, I'm not sure if you're saving up for a house, but if you want to buy a house in 5 years, as much as the stock market is a great opportunity long term, I can't recommend that you put that money in the stock market. If you really need, if you want the likelihood of achieving the equity returns that the stock market provides, you have to really count on being vested either for you or your heirs that 10-year period or so. It's sort of almost the minimal. And the stocks of even the S&P 500 has gone as long as 17 years underperforming bonds. So you have to have that long-term perspective to succeed.
We've got a couple questions, but that we'll wait till the end to address those. Thank you so much.
Okay, thank you. So last year was an interesting year. And this always points to the difficulty of sort of chasing the last year's winners or sectors. Energy was 2 years in a row the best performing sector, and more often than not, however, this is a 4-year look back on the S&P select sectors. More often than not, the best performing sector 1 year turns out to be the worst performing sector the next. That certainly happened between 2020 and 2021, the big reversal that occurred there. So be careful about chasing last year's winners. Understand what led into that change and whether that's going to carry through going forward. This is a chart I kind of like looking at. This looks at the performance of the various sectors last year. Now, in this case, I've switched over from S&P determined sectors to those sectors that are tracked within the shadow stock portfolio. We used Stock Investor to calculate these ratios and values. But in this particular chart is ranked by the 52-week price change. And this is calculated by the typical stock that is within that index. So these numbers may be a little bit different than the overall market cap weighted average. These are the actual stocks that make up these particular components. And so again, finally seeing a little bit of a transition where all the, with the exception of energy and financial, everything was in the red last year. But we're starting to see, in this case, mid cap starting to do a little bit better than S&P 500. But what's interesting is that the valuation levels, I think, to me, is one of the more interesting things to take a look at. We're seeing that there's a lot of value in some of these underperforming segments that have been out there underperforming for some period of time. Looking long term at the S&P 500, since the 1960s rather, the average price earnings ratio of the S&P 500 has been 17.6, and right now it's above 2021. And the risk there is that if we have a economic downturn, that actually that ratio is going to shoot up. This is what happened. This high peak in the PE ratio was a reflection of the negative earnings impact that occurred during the very short downturn during the pandemic recession. So the risk here is that S&P 500 may be not too far off its average, but will that PE ratio continue to come down, or will it go up as future earnings actually turn out to be pretty negative going forward? And the other consideration is what we've seen as far as alternative investments. This is a chart that has the S&P 500 dividend yield, the 10-year government bond yield, and we've taken the inverse of the PE ratio called the earnings yield. And we see that for only recently, for the last decade, interest rates have been relatively low, and very recently we've seen an uptick in bonds and alternative. That's why we had the big decline in bond prices. But we have some real competition for our eyeballs going forward. Investors don't have to necessarily just invest in stocks to get higher rates of return. So that'll be interesting to see what impact that has on the stock market going forward. When it comes to relative valuation, price to book is really the fundamental element of the shadow stock portfolio. And historically, at least over the history of more recent history of the shadow stock portfolio, looking at, let's say, the S&P 500 small cap index versus large cap index, small caps are riskier, and as is common for a riskier asset, they trade at a lower multiple. So you'd expect a price to book to be lower for a more volatile security than a less volatile security. And normally speaking, over this look back period here, the small cap index had a price to book that was about 0.67 of that of S&P 500. So but what we're seeing now, what we've been seeing lately, is that small caps are much cheaper. When small caps did really well back in the 2000s, they were trading at a much higher premium than historically speaking to large caps. So if you're going to stay invested, I guess, in the marketplace, there's much more interesting values available in the smaller cap arena, I guess, is what this chart is showing. There's no guarantee that will happen, but on a relative valuation basis, there's much more interesting values in that smaller cap arena than there are in large cap arena. Even though the large cap price to book has come down a little bit this year versus the year prior, it's still on a relative basis to small caps much more expensive than we've seen in the past, or oppositely, small caps are much cheaper than we've been in some time. Looking at the composition of the shadow stock portfolio, and this is always the challenge. We don't do any kind of picking of sectors when it comes to the model shadow stock portfolio. And when you're talking about diversification, it's always nice to have a little bit of spread. This chart here just simply shows us using the sectors that are provided to us by Refinitiv in Stock Investor Pro. We have a very high weighting currently in the consumer cyclical area. We've got 10 shadow stocks that are consumer cyclicals, 3 that are basic materials, 2 energy stocks, 1 healthcare stock, a lot of industrials, 10 industrials, and 4 tech stocks. By rule, we don't have any financials or utilities. And some of these sectors, academic and educational services, are very small. I'm not likely to have many stocks, but understand that the sector holdings in your portfolio will sort of dictate how you happen to do going forward. So it's always helpful to take a look at your sector holdings. If you push your portfolio into our model shadow stock into our portfolio tracker online, you can get a sense for how that's holding up. When it comes to, I've hopefully have tried to drive this point home, but it's important to have a long-term perspective with microcaps. They often do have long periods of underperformance and then followed by long periods of outperformance. And we are coming out of a window of long-term underperformance. Hopefully things have turned around. They are more volatile than large caps. And so it's important to have a diversified portfolio. Keep your expectations reasonable. It's efficient. The market does a pretty good job of determining which companies are what their prices are, but they are occasionally pushed into levels of inefficiency. And with the model shadow stock portfolio, we're trying to find those pockets of inefficiency. It's a relatively easy portfolio to track. You don't have to follow it that carefully. We're talking about a quarterly in-depth examination. Of course, you have to keep on top of news, make sure nothing really odd happens, like a buyout. But it doesn't require that much effort, and it's with brokerage costs being very low and attractive, free. It's relatively cost-effective to put together your portfolio. All the tools are available for you as a member online to either track the model portfolio or build your own portfolio. But it's important that if you are going to do this, you have the discipline to follow both the buy rules and the sell rules. And when it comes to small caps portfolio like this one, turnover is important. Tax efficiency is important. And we've tried to design all the rules to help make it as tax efficient as possible. So with that, I know we've gone a few minutes over, but I'll be happy to take questions for the next 5-10 minutes.
Yeah, we got some great ones. I would just want to thank everybody for, attending today, and then also for sending in all their questions, because they've been phenomenal. I had to actually I had to prioritize them because there are so many of them, and I want to make sure that we, get to as many as we can. But then also, just to, as far as time constraints and everything, you can always email us at members@aai.com, and we can answer those questions there as well if they don't get addressed today. But let's see. We'll start with so actually a couple people asked us towards the beginning of the presentation, but we talk about a lot of the buy criteria or the sell criteria for stocks in the shadow portfolio. But is there any way to create a shadow stock mutual for mutual funds or ETFs, or how would that work? And why not have we done it?
There aren't really that many mutual funds that go into the same microcap segment of as a shadow stock. There is a DFA has a microcap focused fund, and I think Bridgeway as well has a relatively microcap fund. But for the most part, the managers make money by managing a lot of money. And when the assets get to be too large, it becomes difficult to actually put together a portfolio of these microcaps holdings. So it's actually a challenge for institutional investors to manage a microcap portfolio, because as soon as they start buying these stocks, they have to buy too many of them to actually be able to invest their assets. So it's a difficult arena for the institutional marketplace to actually participate in, which is why it's so well suited for the individual investor.
That makes sense. And let's see. So as we're talking about small caps, primarily, but we had a question from Victor. He talks about the penny stocks, so things that he considers maybe below $4 or so. So are those included in the shadow stock portfolio? And then are there any considerations associated with dropping stocks that are too low? So maybe not the $4, but maybe even lower than that.
Yeah, well, one of the requirements, at least for initially being added to the portfolio, is a minimum $4 share price and exchange listing. And so we do definitely stay out of the arena of these penny stocks, OTC stocks. We did go through there was a period where the Sarbanes-Oxley rules were put into effect, and it became expensive, more expensive for some of these smaller companies to stay listed on the exchange. So we did go through a period of there were a couple of companies that chose to become delisted, but generally speaking, it's a good idea to just stay within the world of exchange listed stocks. There's plenty of opportunities there. There's plenty of stocks that are in the shadows. I know it's sometimes appealing to try to find some of these, very low price stocks, but there's no reason why you have to go there. You can get a good diversification with exchange listed stocks that are well regulated, have a lot of information, and are more easy to transact in.
Another question, actually, this was a great question that I thought is obviously very timely, but do you expect the high interest environment to impact the shadow stock portfolio, especially in 2023?
In general, I think a high interest rate environment would probably have a little bit of a drag on equity ownership in general. So yes, although I wonder whether or not a high interest rate environment would impact more the dividend type stocks more, which are seen as a direct competitor, more of a direct competitor to bonds than perhaps these holdings. People typically buy these microcap stocks not for their yield, but more for their capital appreciation potential. But in general, for many years when interest rates were so low, equities was the one place where an investor could try to go to and get a little bit higher return potential. And now that bonds have had their big decline in price, they might be more attractive going forward.
And we actually have a new investor with us today, and he had a question, Denny. He had a question about, if for new investors who have a long time horizon, so 30, 40 years ahead of them, if you were to decide to buy the portfolio as a whole, should you be concerned about which type of account you choose? So such as like a tax deferred or something like that. Should that play into your decision process as you buy the shadow stock portfolio?
For the most part, as we noted, the turnover ratio is relatively low for shadow stocks. We typically own stocks for about 4 years on average. So most of the gains are long-term capital gains. There aren't some of these stocks do pay dividend income, but there typically is not the overall yield is not that great. So we do try to manage the shadow stock portfolio in a tax efficient way. And one of the advantages of managing a individual stock portfolio yourself is, you have a little bit of discretion. Do you want to, if you could hold a stock for a year and make sure it's a long-term gain when it comes to sell it if you want to. So I think of within the if you have a diversified portfolio, the shadow stock portfolio could work equally well in a tax deferred or a taxable account. If you have a choice, you might want to put something that is a higher yield, larger cap portfolio in a tax deferred, if you have that opportunity to mix and match where you put your assets. For the most part, the shadow stock portfolio is managed in a fairly tax efficient way, and you have a lot of control over your individual buys and sells that way.
Makes sense. And I think we'll just do two more just because of the time. So one is, what type of investor, you kind of mentioned this a little bit earlier in the presentation, but what type of investor is the shadow stock portfolio and strategy geared towards?
Well, it is a little bit riskier or more volatile approach than, say, the overall stock market is concerned, especially when talking about the S&P 500. And it does take a little bit of a longer term perspective. So you could try to look at diversifying your holdings. I think it's a good complement to the large cap equity portion of your portfolio. So it's suitable to, I think, anybody but the most conservative investor, if that makes any sense. Someone who has the ability to take a longer term perspective and who can absorb some of the short term declines that have been the case with the portfolio. I mean, we you have to be able to absorb we've seen 40% declines, right? And the worst thing you could do is sell it when the portfolio is down because of a bear market. You turn a paper loss into a real loss, and then you got to try to make that money back. So you have to be able to absorb that volatility, some of those drawdowns that will occur. So it requires a little bit of a long-term perspective and the ability to withstand that risk. I mean, it was very painful at the start of the pandemic. It was a very short bear market. Last year was a little bit of a longer bear market, but it takes a little bit of patience and discipline to keep holding on to it.
Makes sense. And last one we'll have, and then the last one I'll do is so how should I use the ideas list? I mean, we have someone who says, I'm always confused whether I should be following the portfolio or creating my own based on the rules and overall strategy. So what do we recommend?
I mean, it depends on how active you want to be. If you really want to kind of do it on your own, and it doesn't take that much effort. We're talking about 4 times a year. The ideas list is a great chance to build upon and make your own portfolio. If you simply want to follow along with what we do, then you could just track the model shadow stock portfolio. They are both capturing the same kind of companies, and as long as you are disciplined in your buying approach and selling approach, you should have similar rates of return. It just depends upon, do you want that extra effort? Not that much extra, but do you want to take the time and effort? Because if you are going to be tracking the ideas on your own, you're going to have to keep an eye on when it comes time to sell. So it depends upon how active you want to be. Some of our members like to be very active and would love just to work off the ideas list as a starting point, whereas others would just prefer to have majority of their money in an index fund. That's fine too. They're both going to get you where you need to go. The question is, do you want a automatic transmission in your car? Or do you want a stick shift? Do you want that thrill of controlling things, or do you want to have cruise control on?
Well, that's all the questions right now. But I just wanted to, John, if you have any last remarks before I go into my outro.
No, but I was thank everybody for coming in and attending our session today. There's a lot of information, and I designed the handout to give you a lot of reference material, so I didn't necessarily go through everything in detail for our presentation today. But I think the beauty of the model shadow stock portfolio is it illustrates how you, as an individual investor, have certain opportunities put forth to you that, as long as you have a disciplined approach based upon sound investing principles, you have the opportunity to go ahead and reach your financial dreams and desires. But it does require a little bit of education and a lot of discipline. But we have a great community here, and thank you for joining us. And I think we learn from each other. And as I think over the years, it's been a great experience and an experiment. And I think it's shown that there are opportunities to invest in individual stocks, and often as individuals, we have opportunities that institutions don't.
Couldn't agree more. Thank you so much, John. I really appreciate your
Thank you,
time.
Jenna. Pleasure.
And if you have any questions about the AAI Shadow Stock Portfolio or the strategy, I just want to remind our viewers that you can feel free to email us at members@aai.com. And if you haven't delved into the Shadow Stock Portfolio yet, but you want to, you can visit aai.com/model-portfolios. I can drop the link one more time into the chat, but we'll also have all of those resources for you tomorrow afternoon on the aai.com/webinars page. But I just want to remind everybody that also that this is an included AAII benefit for all regular and lifetime members. So there you can, if you go into the model portfolios page, you can find the shadow stack ideas that we mentioned, the portfolio's performance, regular updates that we do, as well as a pretty robust how-to section. So that'll give you the strategy, any kind of buy, sell rules that we mentioned today, a really helpful user guide, and so much more. And, just to also, if you're interested in registering for any upcoming AAII webinars or other events, you can visit aai.com/webinars. And to mention again, because a couple people asked, this presentation is recorded and a replay of the webinar will be available tomorrow, usually around the afternoon, around 3 or 4 on AAII's YouTube channel, along with links to this presentation's handouts and any resources that we discussed. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you and take care.
Take care.